Ladies and gentlemen, welcome to The Plain Bagel. I'm your host, Richard Coffin. As you've probably seen by now, Evergrande, the massive Chinese real estate developer, is back in the news. The company that first experienced some financial turmoil a few years ago, raising concerns over the state of China's real estate sector, has now filed for Chapter 15 bankruptcy protection in the United States. It comes at a concerning time where China has seen its economic growth forecasts cut due to lower exports and consumer spending, with many once again raising the concern over the risk of contagion. The idea that the troubles experienced by this company and the real estate sector as a whole could spread to other areas both within China and even outside of that economy. Now, Evergrande is a company I've more or less touched on annually since late 2021, and I've gotten a lot of requests to talk about this most recent update. So I wanted to take an opportunity to explain where we stand with the Evergrande situation, the state of the Chinese real estate sector, and what this all could mean for the global economy as well as China's economy itself. But I also wanted to clear a few things up about the situation because the Chapter 15 filing isn't really that big of an update. And naturally, with an event like this, we've already started to see the comparisons to America's 2008 financial crisis, with some even going so far as to call this the end of China as we know it. But rather than trying to predict what will happen one way or another, my hope is just to provide a neutral description of what's happening and to offer some context, because the situation, well, it does involve a troubled real estate sector, and that can have very severe implications for the global economy. There are still some very key differences with what the US has gone through that I've touched on in the past, but I want to reiterate with this video. But before hopping into the most recent update, let's do a recap of the Evergrande situation. If you want to skip this part, you can do so using the chapters in the video timeline. Evergrande, as you might recall, first sort of entered the Western news cycle in late 2021 after nearly defaulting on some US bond payments, which was notable because the company is China's second largest real estate developer and the most indebted developer in the world, with over $300 billion in liabilities and over $120 billion in borrowings as of the first half of 2020. And while this leverage did help the company rapidly expand operations during a time when real estate was booming, in late 2020, China introduced its 3 red lines rule, which was a set of 3 leverage metrics that, if a company violated, would impose increasing restrictions on the company's ability to expand leverage. And right away, Evergrande violated all 3. Meaning that it could no longer take on additional debt. Now, for some companies, that might not be a severe problem if you're able to sell assets and deleverage, but for Evergrande specifically, the majority of its assets were tied up in incomplete development projects that it could now no longer raise money to complete. On top of that, the company had also been funding a lot of its operations using pre-sales for new developments, meaning that it was effectively taking money from customers for new promised commitments and using that money to fund past commitments. And as the company started selling properties at a discount to try and meet that funding gap, customers started pulling back their demand for fear that the company would not be solvent enough to complete their obligations, which brought us to those late 2021 headlines when the company missed a technical payment deadline for some of its bonds. Now, funny enough, the company did actually manage to make those payments within a grace period, but the company did experience an actual default in December, again for US dollar bonds. And really, since then, they haven't been having a good time. The Hong Kong listed stock for the firm has had its trading halted since March of 2022. The company had its Hong Kong office seized by creditors. There's a boycott from a bunch of customers that we touched on last year who refused to make their mortgage payments until Evergrande followed through on its development commitments. The CEO and CFO of the company actually stepped down after it was discovered that the company had pledged $2 billion in deposits from its Evergrande Property Services business as collateral, which it thereafter lost. Revenue for 2022 was less than half of what it was in 2020, and over the past 2 years, the company has experienced significant losses, with a large write-down in 2021 of roughly 1/5 of its property inventory. And despite efforts to try and turn around the business, as of 2022 year-end, the company has $107 billion in contract obligations, primarily property development commitments, as well as $91 billion worth of borrowings. Which all leads us to the recent headline that the company filed for Chapter 15 bankruptcy protection in the United States. It was filed in a Manhattan court on Thursday, August 17th, and it involves a total of $31.7 billion of borrowings, roughly a third of its outstanding debt. Now here it's worth highlighting that Chapter 15 bankruptcy does differ from what you might typically consider declaring bankruptcy. There's no liquidation involved, and it even has differences with a Chapter 11 bankruptcy, which is what you'll typically see companies go through in the United States. A Chapter 15 bankruptcy basically involves a foreign company going through a restructuring discussion elsewhere, asking US courts to coordinate and recognize the process since there are US creditors involved. In this case, the filing involves US dollar denominated bonds under the legal systems of Hong Kong and the British Virgin Islands, and if it's accepted, it will allow the company to continue its restructuring negotiations without worrying about US creditors trying to sue them or seize any assets that they're able to, with the company itself iterating that the filing is, quote, a normal procedure for the offshore debt restructuring and does not involve bankruptcy petition. And that's why I say this isn't really a massive update for the company, because we already knew that the firm was going through restructuring discussions. They were actually announced back in March of this year. The plan involving swapping debt for either new, longer maturity bonds or other equity-linked instruments. In fact, the filing might actually suggest that the company is nearing the end of its restructuring negotiations with investors. It just needs approval from a bankruptcy court in New York, given that they are governed by New York state law. So while there are a lot of headlines about Evergrande declaring bankruptcy, it's worth highlighting that the company is trying to survive and turn itself around. And we'll just have to wait to see if the bankruptcy courts approve the filing and if the company is able to make the significant improvements required to survive past this. Even though with this restructuring, Evergrande does remain in a precarious situation. So that's where we stand with Evergrande. And if the story was just isolated to Evergrande itself, even though it is a massive real estate developer, it probably wouldn't be as big of a story. But the reason why so many are concerned about this situation is the fact that many view it as just a symptom of a more systemic issue with China's real estate market. Real estate is a very important sector for China. It represents 30% of gross domestic product, and globally, China's property sector is actually considered the world's largest asset class with a value of $62 trillion. Within the country, real estate is also viewed as a key investment category, with the category representing 2/3 of private household asset allocations compared to the minuscule 4% allocated to stocks, leading to 70% of Chinese household wealth being tied to real estate, making it pretty important. And before the Evergrande situation, real estate prices were rising drastically, reaching an average property price to income ratio of 32.3 times, which is compared to New York City at 10 times. But recently, the real estate market has sputtered. It's not that prices have fallen drastically at the average level. New builds are down only 2.4% from their high in August of 2021, while prices for existing homes have dropped 6%. But we have seen sales volume drop more drastically, with property sales by floor area falling 28.1% year over year in June, and new home sales for the top 100 developers in China dropping by about a third in June and July from a year ago, according to S&P Global Ratings. And while Evergrande has been the poster child of the struggling industry, they are far from the only ones involved. 2/3 of China's top developers violated at least one of the red line rules when it was first announced. And since mid-2021, companies accounting for 40% of Chinese home sales have defaulted on one of their obligations, which is what's led to these eerie scenes of ghost cities, with developers having built well past what demand could sustain and no longer able to fulfill commitments on started projects. We have these seemingly abandoned cities of incomplete buildings, some of which are actually ordered to be demolished before they're completed. So naturally, there are also concerns about other developers, with news articles most recently highlighting Country Garden, which is China's largest non-state-owned developer, who itself is looking to restructure $535 million worth of bond payments over the next 3 years, and is already late on $2 bond payments due August 7th, worth $22.5 million. And given how important the real estate market is for China, all this has really renewed fears of contagion. Again, the idea that this could spread to other areas, both within China and outside of it. And to an extent, we've already seen some troubles in different areas. Asset manager Zongrong, I know I'm butchering that. A company with exposure to the real estate market has itself defaulted on several investment product payments, which has caused investors to protest. And naturally, a collapse of the real estate market would impact financial institutions, households, investors, suppliers. And with China representing 30% of global manufacturing in 2021, some worry the impact will be felt elsewhere as well. So that is the situation. Obviously a very drastic one for China and its real estate market. And it's very likely we'll continue to see some problems from the space over the next few years. This is not an easy fix, and it's likely to be painful for a lot of stakeholders. But again, I have seen a number of claims that this is once again 2008 2.0, that we're going to see a similar impact that we saw with the collapse of the real estate market in the United States. And while there are obviously parallels between these two things, I do want to highlight some additional points, some additional context to really put this into perspective. For one, the problems being experienced by China's real estate market do appear to be focused on less developed regions, where supply has well outstripped demand, and there are actually expectations of a shrinking population, which is why segregating the prices by their tiers, which more or less just means dividing regions based on their density and economic output, shows a clear divergence of home prices. Now, this isn't inherently good news. Country Garden is in trouble because 61% of its developments are in those cities, and most of China's housing and GDP come from this area. So there is still expected to be an impact, but property prices in Tier 1 and Tier 2 cities, where prices are actually higher, have oddly enough been more stable. Secondly, probably the biggest point to highlight here when comparing this to the Lehman Brothers moment of 2008 is that China's real estate market is much less intertwined in the global financial market than the US real estate market was back then. America really exported a lot of its exposure via investment products that not only tied their performance to the real estate market, but actually leveraged it via financial engineering, which is what led to this massive blow up when that market performed poorly. China really doesn't have that. They're quite protectionist about their investment opportunities, and the US direct exposure to China is quite small. That's not to say we wouldn't see an impact from the world's second largest economy seeing a slowdown. We would likely see some sort of influence over commodity prices, which could drop due to lower demand from China and have that international influence. And obviously countries with closer ties to China, much of the developing world, for example, will likely see a more acute impact. But when it comes to the nasty chain reaction that we saw with 2008, largely due to their mortgage-backed securities and the derivatives thereof, we just don't have that with the situation. Thirdly, I do want to highlight some caveats around debt within the country, because while commercial leverage is extended within China, household debt is actually far from where it was back in the US for 2008. As of March, household debt accounted for 63.3% of the country's GDP, compared to nearly 100% in the US leading up to the financial crisis. On top of that, while there are concerns around the debt load of local governments, most of the country's debt is actually internal, with external debt only representing 14% of GDP compared to the US at 96.4%, which gives the country a lot more control to facilitate the resolution of these debt obligations. Which leads us to the fourth point, which is that we could see a big move come from the Chinese government to try and mitigate the situation. As we've seen in the past, the government very heavily involved with how its industries do things. And while there are concerns about the country recently reporting deflation and how that's indicative of slowing economic growth, it does give the country more monetary flexibility, with, in fact, the country recently cutting many of its key interest rates and earlier this year essentially shelved its three red line policy, with banks extending credit to troubled developers. Now, that's not to say the Chinese government can perfectly manufacture its way out of the situation. The yuan did recently hit a 16-year low against the US dollar, and it's unlikely we'll see the government take on the extra debt to enact the same sort of stimulus we saw back in 2008. But obviously, having a government that could potentially get heavily involved in the situation will play a role. That being said, the Chinese government to date has not offered a clear action plan, and we unfortunately don't really know how things will play out. Chinese market is a very opaque one. The government recently reported youth unemployment that was disappointing and stopped reporting it thereafter. So makes it difficult to really figure out what's happening. But on top of that, there are many parties that can influence what will happen here. The creditors, the bankruptcy courts, the government, Evergrande's management itself, and the customers for the properties. And there are just a multitude of variables that are very difficult to predict that will have an influence here. Even the United States potentially cutting rates could influence how things play out. What is clear, however, is that the Chinese real estate market does appear to be in trouble, is experiencing a lot of turmoil, and that's going to impact a lot of households within the country, which is made worse by the fact that a lot of families actually pool their money together to make these investments. So regardless of how things play out at the world stage, there is going to be that really unfortunate impact for a lot of families. Still, for any investor who's trying to interpret the situation and worried about a global downturn, which is a possibility. It's not to discount what could very well happen. But hopefully I've demonstrated the situation is likely to be different from a 2008 financial crisis. And as always, it's typically best to focus on the long term. There's always going to be bad news to focus on to convince you that you shouldn't be investing your money. And your money will potentially go up and down in value by quite a bit. But if you focus on a diligent and relatively diversified investment strategy, and if you have faith in your investments, you're likely to do best by just, again, focusing on that longer time horizon. Anyway, that's the video. I do apologize for losing my voice through this. I seem to be coming down with something, but thank you for joining me. And I hope this video did still help to address the situation and give some of that context. Again, not to predict one way or the other, just to provide more hopefully neutral information. If you like the video, please do make sure to like, subscribe, all that good stuff. It does help the channel tremendously. And let me know your thoughts on the situation down below. Are you more optimistic or pessimistic? I really would encourage that discussion. Thanks again for joining. And as always, be safe out there.